Here's why. Asking for a seller credit can actually lower your payment rather than asking for a price reduction. And depending on the scenario, that can actually be better for you if you're looking at getting a lower monthly payment. Hey, what's up? It's Benj here with Triple Cord Real Estate, and I'm with David Moberly from Academy Mortgage, and he's going to talk to us a bit about how mortgage payments work, PMI, and some different strategies and how to lower your monthly payment in this high interest climate that we're in right now.
Yeah, so primarily what we're looking at these days is how do we make a challenging, expensive housing market more affordable? Because that's really what matters. We have to have a place to stay. We have to make the mortgage payment every month. So we're going to talk about a few different strategies today. One of them is going to revolve around buying a lower interest rate. One of them is going to revolve around how do we pay for mortgage insurance singly instead of monthly. And then the last thing that we're going to talk about is what's called a 2-1 buydown, which gives you a short-term relief and a lower interest rate for an introductory period.
And that sounds great. We actually have some lists. I actually pulled a listing that is on the market right now. And so we can actually see some real numbers of how you could actually buy this house and see how a promo that they're offering or maybe asking for a credit, how that could lower your monthly payment. So
Yep.
Yeah, let's jump right into it.
Sure. So to start off with, it's important to remember there's three main features of every mortgage payment. The first one is your principal and interest, which is just a reflection of how much are you borrowing and what's your interest rate. The second is your taxes and insurance. Those are your escrow account. And the third one is going to be for some loans, you may have a mortgage insurance premium if you're putting less than 20% down. The first one we're going to talk about is sort of a combination of interest rate reduction and mortgage insurance premium. So in the listing that Benj has, this is a purchase price of $394,000. And for a home that's been sitting on the market, this could work whether it's a builder, an existing home. But you've got a couple of options. Say the home probably needs to come down in price a little bit. We could do option one, which is reduce the purchase price by $20,000. And that would have an impact to your monthly payment of around $100 per month. So not bad. But the strategies we're going to talk about are how do we get even lower than that? And so what we would say is in this situation, it may be a great opportunity rather than ask for a reduced sales price, let's ask for a seller credit in the amount of $20,000 to purchase a lower interest rate and to pay for an upfront mortgage insurance premium.
And that's not just something that's totally theoretical in this market. In this listing, actually, the builder is offering a $20,000 credit. It's a $20,000 promo. So rather than just taking that off of the purchase price, let's use that to actually lower the monthly payments.
Yep.
Walk us through it.
So in this example, we've got a normal rate today, what we call a base rate, and this is based on today's rates. They change, but today a no points interest rate, we're using a base rate of 6.25%. So for a home that's $394,000 with 5% down, that would be a monthly principal and interest payment of $2,305. So the first strategy we're going to employ is purchasing a lower interest rate. In this case, we're going to use 2 points or 2% of the loan amount, which adds up to $7,486. We're going to use that to buy the interest rate down from 6.25 all the way down to 5.375, giving us a new principal and interest payment of $2,096. So right off the bat, we're almost $200. We're $190 less than we would have been by just simply lowering the purchase price. The second strategy gets a little more complicated, but it is really pretty easy to do. Rather than paying $90 a month for monthly mortgage insurance, what we're going to do in this situation is we're going to just pay for a single mortgage insurance premium upfront at closing in the amount of $5,500. So in this situation, now we're not only dropping our mortgage payment by $190 per month, we're also removing $90 a month in mortgage insurance for a cumulative savings of $280 per month versus about $100 that you'd save by reducing the purchase price. So the thing to keep in mind is this is going to take your loan's closing costs, normal closing costs, lender fees, title insurance, the setup of your new escrow. Normally I would say that's going to be about $4,000. Employing this strategy, your closing costs jump up by about $13,000 because we're paying 2% of the loan amount, which is that $7,500, and we're spending $5,500 in mortgage insurance premium. So now we have $17,000 in closing costs, but in this situation, the builder's paying for those or the seller, and you're taking your monthly mortgage insurance payment from what would be about $2,600 to, if we did a price reduction, to below $2,400. So that's why we think that's a good use of those funds.
Right.
The other thing what we say is when you look at a home that you already made an offer and your contract on, if you can see that the comparable sales support above the asking price, that might be another opportunity to, say you could have got the home for $375. But raise that purchase price to $395 and use the $20,000. And you don't actually need 20; it's more like $17,000. But use that money to, instead of save $100 a month, save more like $300 a month.
And so, which kind of a person would this scenario be most applicable to?
So, the first thing I would say is this is more of a long-term strategy. Typically, it's about a 4-year recovery period where paying for the mortgage insurance premium up front and buying those interest rate points pay for themselves. They pay for themselves eventually through savings per month, but it doesn't happen overnight. So if you're planning on living in the home for a year, this isn't a strategy I'd recommend. If you're planning on living in the home for at least 4 years, 5 years, I think this is a great strategy to think about.
Well, tell us about the third one.
So the third strategy is what's called a 2-1 buydown. And it's a little gimmicky, I'll be honest with you, but it's a strategy that we used to employ quite a bit with new build jobs. And the way that it works is it's a normal 30-year fixed loan, but for the first year, your interest rate is 2% lower than your final loan or your final note rate. In the second year, it's 1% lower. And then in year 3, your interest rate reverts to the actual interest rate that we're locked at. So for example, if today the interest rate is 6.25%, in your first year, the rate's 4.25, and that's what your payment is based on. In the second year, it's 5.25, and that's what your payment is based on. And in the third year, that's where that payment hits that 6.25. It's not a variable rate, it's a fixed 30-year rate, but you get a discount for the first 2 years that you're in the loan.
And in order to do that, basically what you're doing is you're paying the interest up front.
That's right. Yep. So we would take all the interest savings that you've taken in year 2 and in year 1, we add that together, and that becomes a closing cost paid by the seller once we're at closing.
And who would want to do that kind of a deal?
That would be especially more to me someone that anticipates future income being higher than it is right now. You're not really saving money. What you're doing is you're shifting away that those funds are collected. So you're in your third year of business. Things are starting to take off. Things are starting to go really well, and you're confident that in year 5, you're not going to be uncomfortable with a higher payment. But right now, you're a little bit nervous about that payment.
Or maybe you just get hired on as more like you sort of get entry level pay,
right.
But 1 year later, 2 years later, they bump you up into the next the next payment bracket.
Right.
That might be
This would allow you to take advantage of a lower payment in the short term while you're waiting for your compensation to rise.
And what would the numbers look like on this?
So using this house, same exact house as a scenario, $394,000 purchase price. Typically on a 2-1 buy down, you're going to see a slight increase in the interest rate. So in this case, rather than a 6.25 base rate, I'm using my numbers on a 6.375.
Okay.
That's not always the case. It kind of can shift from market to market. But essentially what you're looking at in year 1, you're going to save approximately $500 per month. Year 2, it's not quite, it's about $490. In year 2, it's about $285 per month. And then what we do is we're going to collect all those savings, and you're going to have a closing cost of about $8,500 that's going to be collected at closing. So that in your first year, your payment might be $2,250. Year 2, your payment would be $2,485. And then in year 3, when we add the mortgage insurance, taxes and insurance, all that, you're looking at a payment of more like $2,725.
Cool. Great strategies. Thanks so much, David. Appreciate it. If you have any questions, obviously he knows the numbers better than I do. So reach out to him, David Moberly, Academy Mortgage. I'll put his info on the screen there, and he can walk you through all the numbers as it relates to you more specifically, your income and all of that. He'll get you set up. So thanks again, David.
My pleasure. Thanks for having me.
Okay. Take care.